So many baby boomers obviously look forward to retirement. One way to look at retirement is trying to survive without a paycheck. And the fact is that taxes don't even stop when your paycheck does. My guest is Bo Crawford, who practices in Beaumont, Texas. So Bo, when somebody retires, all that money, all those assets that they've accumulated during their working life now needs to be turned into income, and that creates a tax liability. Can you talk about the 401k?
Well, what people oftentimes do not realize when they are putting money into an IRA or a 401k, they're not, it's not a tax deduction, it's merely a tax deferral. And oftentimes people don't realize when they retire that they actually have a tax liability in their IRA or 401k. And another thing that they need to be aware of is they may have deferred tax in a lower tax rate, and when they retire, their tax rate may even be higher than what it was when they deferred that money into it. Consequently, they really may not have received any great benefits at all because the taxes are much higher than what they expected them to be. So in planning for retirement, people need to be aware of not only the accumulation side of building up money in their retirement account, but they need to be aware in advance of what the distribution is going to be on the backside and how that's going to impact the money that they need for retirement.
So with a conventional IRA, there are required minimum distributions, also known as RMDs. Are there ways to minimize the taxation on those?
Well, there are a couple of things that people can do. One is, if they plan out far enough in advance of retirement, they can actually start taking money out of their IRA under what you call a Regulation 72T calculation, which they could, they would still have to pay the tax, but they wouldn't have to pay the penalty if they use the 72T. And so that might be a way that they can start getting money out of their retirement account, prior to 59 and a half without a penalty. But then when they actually retire, there are strategies that we use in our practice that can help the clients, maybe not eliminate the tax, but spread the tax out over a longer period of time and use other vehicles that can actually convert taxable income into tax-free income.
Well, finally, how can life insurance be used to create tax-efficient income?
Well, what most people aren't even aware of this is that there's a sort of a new generation of a life insurance product that's kind of an investment grade product where the returns are linked to some stock market index such as the S&P or the Dow Jones average. And these products, can give the clients upside gains up to a cap of maybe 12 to 14%, but then they're protected on the downside. And then when they get ready to retire, they can start accessing these funds via what you call policy loans that will come out to them tax-free. So they have had the benefit of the tax deferral during the accumulation period, and then when they actually retire, they can convert that to tax-free income, which can provide much greater income to them than what they had maybe originally planned for.
My guest has been Bo Crawford, who practices in Beaumont, Texas. Thanks for watching Retirement News Online.